Yeah, Vega becomes really important. There are a few Greek nuances that are important. Vega becomes very important because the volatility is just so heavy. The Vegas are just so meaty. Delta and where exactly that 50 delta sits is also really important. The best way to think about it, as far as I'm concerned, is think in terms that it still is the at the money, even though it's not. If you look at a leaps option, like I'm pulling up here match group, and let's just look at the long-term doozies here. January 15th of 2027. So match is trading at 34.40 as I speak. But if you look at the 35, which would be the closest to the money calls, they already have a 58 delta and a 35 puts, consequently a 40 delta. If we go up to the 40 strike calls, they have a 52 delta. Their delta is like they're still in the money, even though they're about 10% out of the money. So why is that? I find the best way to think about it is if you think of a stock and how stock prices are distributed, given the log normal distribution curve, there's an expectation because of the interest rate and because of reinvestment and because of just how the log normal curve is shaped, that in the future, the stock should be trading at a higher price. And so because of all that, I just look at it as, well, the at the money 534 days out is a higher price than where the stock is at the money right now. And so because of that, if I buy an actual technical at the money, like in this case, a 35 strike, I get a much bigger delta, which kind of gives me just this automatic benefit if I'm looking for it as a stock replacement or just a bullish long call type scenario. And it's an important thing to keep in mind when you're constructing a spread around that L.E.A.P.S.